Hi, it's Glenn McQueenie, and welcome to my 25-minute Success Series podcast. Today, we have a kind of a different theme that we're going to go after, and this is going to be more on the kind of education, information realm, because I think part of your job as an agent is really to continually add more value, more knowledge, more insight to your clients because that's really the basis of what a great consulting relationship, and it also I think positions you to get lots of referrals and just really be seen as the specialist in your field. So today, I'm kind of excited. We have senior mortgage agent Rocco Mongelli from Mortgage Savvy team. How are you doing today, Rocco?
Oh, I'm doing great, Glenn. How are you?
I'm good. So, Rocco, just the reason I wanted to kind of get you on the line here is I really wanted to talk to an expert who can maybe give insight to probably more of the Canadian market. So I know we have international listeners here, but there's been some recent changes to the mortgage lending rules, and I just wanted you to kind of, fill us in, let us know what's going on. But before we start, I've got a bunch of questions for you. Just tell me a little bit about you and your background, Rocco.
Yeah, for sure. So my background has always been in sales. I was in the corporate world back from the early 90s all the way up until about 2006 when I was approached from a few friends of mine who were in the mortgage industry, and they knew my sales background, and they knew that I was kind of stale in the corporate world and said, hey, why don't you come in and join us? We think you'd be great. So I always had a little bit of a affliction with mortgages, and I kind of kept my knowledge up to date, even though I wasn't in the industry. So I started with Royal Bank in 2006, and from 2006 to today, I've had a few different roles, predominantly as a mortgage agent. I moved from RBC to CIBC, and then from CIBC is when I moved over to the broker channel. And once I moved over to the broker channel, I kind of focused on both sourcing business and underwriting, because I always thought that there was a lack of knowledge within a lot of the agents who were out there and putting deals together. So I kind of said, you know what, here's a little bit of a niche that I can maybe focus on and start to underwrite deals for other mortgage agents who are either new into the business or not as knowledgeable with all the lenders that we were dealing with. Just to give you a background, we deal with 39 different lenders, and they all have different little quirks about them, but we always, have an opportunity to get deals done. And I think that's helped me over the last few years. I've joined Mortgage Savvy and Raki Dingra and her great team recently. I've been working with Raki for almost a year now, but officially joined a few months ago, and that's where I am today, both sourcing business and still underwriting deals, and having to keep up to date with our dynamic industry, that's for sure.
That's great. So just to be clear, because I think what most agents probably don't realize is there's one thing to source the deal and actually to get the application and to get it submitted. But then there's a whole second part, which is probably the most important part, which is the underwriting. So can you just tell us a bit more about what the underwriter's role is?
Yeah, absolutely. So the underwriter's role is really to gather all the information on that particular client, their income, their debt load, what their goals are, the purchase price, the down payment, all the aspects, and really understand where to place that mortgage, because we have so many lenders out there that we can dip into. It's not just about rate. It goes beyond rate. It goes to prepayment penalties. What happens if you needed to break your term? What is your 5-year plan? Are you looking to refinance in 3 years and renovate your home? So we want to make sure that right from the beginning, as we're underwriting that deal, that we're putting them in the right situation with the right lender that will give them that flexibility to do what they want to do going forward. It's not just about putting a mortgage deal together and have it close and not hear from them again. So underwriting the deal is probably the most important aspect. And not only that, as if you're knowledgeable as an underwriter and being a mortgage agent, you know what the lenders are looking for. So when you are building that business case, essentially, I tell people that's what we do. We build business cases for a living. When you are building that business case for the lender, they're already prepared for what's coming in, and you could really reduce that time that it takes to get an approval.
Yeah, and I think that's what I don't think most buyers or sellers or agents really realize is it's not just here's my income, here's what the rate is. It's really, you know, if you don't fit inside this perfect box with this lender, then you guys have the ability to pick them up and put them in another box, like if they're business for self, compared to like like teacher income or something super secure income. And I think moving forward, and I know I'm kind of excited about to talk about these new mortgage rules, but I think moving forward, that's really going to be the biggest value add that you'll be doing. And I know that's, of course, why we're partners with you guys, because it's not about writing the offer. It's not about getting the condition and financing. It's about actually getting an approval and getting that deal to closing, because that's when the buyers and sellers move on with their life. It's how the agents get paid. It's how everyone else moves in this role.
Absolutely, and there is a solution for everyone that comes through. I mean, not only on the A business with bank lending, but we do bruised credit and private lending as well. So there is an opportunity for everyone that comes through this channel.
Right. So, just can you get us up to speed on, I guess, the recent? I know the Office of the Superintendent of Financial Institutions has been, I think, came out originally in July and said, hey, we're going to be changing some things. There's going to be some things changing, and then I think they reaffirmed it at the beginning of the month. So what's been happening in the kind of in news just in regards to mortgages lately?
Yeah, you touched on it. So the most imminent one is the OSFI's proposed changes to the lending guideline. Just a bit of background. Last October, they introduced what was called the stress test, and these changes were brought in to have high ratio, or also known as default mortgages, to be qualified at the Bank of Canada rate, regardless of the term. The immediate impact was mostly to the first-time home buyers, from what we saw after the months that it was implemented. Now, those new proposed changes would see all mortgages qualified at the Bank of Canada rate, regardless of how much down payment you have, even those with 20% or more. This proposal really can by the regulator, can expand the stress test to mortgage borrowers who will reduce how much the Canadians can afford by 21%. So it will have a significant impact on the market and affordability. There's absolutely no doubt.
So when do these changes come into effect? What's the timeline for this?
Well, there hasn't been a date as of yet, but we do hear that it may happen within either early sometime this quarter, or potentially by the beginning of next year. News outlets, if you read, there's a lot of information out there that indicated that OSFI is in the midst of finalizing these potential new guidelines, and essentially what they're trying to do is looking to curb the risk of mortgage defaults due to what they say is a high household debt.
Right. So this is probably more about protecting the balance sheets, maybe, of banks and lending institutions, and also the government, who's got to backstop it, than the consumer, right? It's really more of the back end, but the net effect is that the consumer is going to probably qualify for less of a mortgage and will have stricter qualification criteria.
Exactly. That's exactly it. Yeah. So now the Bank of Canada rate is sitting at 4.89%. Or actually, it's actually at 4.94%, but banks are qualifying at 4.89% right now. And if that changes, that means everybody's going to be qualifying at almost 2% higher than the 5-year fixed rate as it is today.
So tell me about, so what is the net impact of these new rules on a consumer? Like, if they were qualified for, say, a $500,000 mortgage before under the old rules, because that was the 5-year at 2.89 or 2.9, and now they have to qualify at 4.89. What difference will that make for them?
Just to give you a quick example, a household income of $100,000 based on a 25-year 5-year fixed rate mortgage at 2.84%. That person can afford a house up to $726,000 in today's environment. Under the new rules, the same household would be able to afford only 573,000, which is approximately a reduction of 150,000. So to keep that into perspective, about 46% of mortgages outstanding in Canada are uninsured, meaning they had more than 20% down previously. So that 46% would be those who would be immediately impacted.
So what does this really mean to the buyers and also to our sellers? What's your viewpoint on that?
To the buyers, it means that the time to act is now. Getting a real estate professional to help them look for that dream home is now. We can help them with pre-approvals at Mortgage Savvy. We still have that ability to help them get into their dream home based on today's lending guidelines. With this, we can protect them from any of the changes that may come up to 120 days from now. For the sellers, the equity that they have worked so hard for can be impacted greatly as well, especially in that equity. And if they're looking to take out that equity and use it for other things, like a potential next purchase of an investment home, a cottage, things like that. So it will have an impact on both the buyers and sellers.
That's, and I don't want to really scare the people who are listening because I don't think that's what we're trying to do. I think it's more about, you just got to, keep current on what's happening and then act yourself, like, govern yourself accordingly. It's almost like that old adage that says, you deal the hand with the cards you're played, not with the cards you wish you had.
Right.
I think it's one of those things right now where, because I guess from my point of view, if someone was a first-time buyer buying their first condo for, say, $400,000 in downtown Toronto, I think under these new rules, they might only be qualified for, say, up to about $320,000. And the only challenge with that is now the marketplace won't match their needs. Like
right.
For $400,000, you can get your starter condo that's actually okay to live in. That you'd like to live in. And once you get down to the 300, 320 level, you just get inferior area, inferior suites, low levels. North facing. So that could have like a big impact on just their enjoyment of the type of property they want to buy.
Absolutely.
And then I'm thinking, on the other hand, like for the people who, as you said earlier, have worked so hard to pay off their houses, and now are like, okay, I don't know, what am I going to do as I help plan for my retirement? Maybe I'll diversify a little bit instead of having all my money in my RSP and in the capital markets. Maybe I'll buy an investment property. I think these rules are basically going to say, like, okay. Well, I'll let you explain what the rules are going to be, but I think from my point of view, I would be like, if you're going to do something, you might want to get that like home equity line of credit locked up now under the old rules, just, because you never have to use the money, but it's nice to have if you ever need it.
Yeah, it's a nice to have, exactly. And because we're acting now and not later, we do still have that ability, as I mentioned before, to qualify you under the old guidelines or today's guidelines. We won't call them old yet because it hasn't happened, but definitely the equity in the market today, the market is still strong. There's still a lot of equity in homes that homeowners can take advantage of, and yes, get into that home equity line to have it there and not necessarily use it, as you said, but as a safety net in case there are changes and it becomes more difficult to do what their plan was.
Mm-hmm. And I always say, like, it's always a great thing to ask for money when you don't need money. Because they tend to give it to you a lot more than when you really do need money. And I know last year we put a new home equity line of credit on our house, just as almost like a rainy day fund, that if anything ever happened that we had to access credit, that it's there and it's sitting in place.
Yeah, exactly. That's exactly the message that we're trying to convey as well. Is now is the time to take advantage of that and have it as a safety net. It's not going to hurt you. If anything, it's going to help. And because we still have that ability to do it under some, we'll call it more lenient guidelines than what's proposed, then yeah, for sure, it's an awesome thing to do.
So I don't want to put you on the spot because we don't really know what this legislation is. They've been hinting at what it could be, but do you have any insight of what it would be just for maybe just that homeowner who's got a lot of equity right now, like the difference between, today's rules and maybe future rules? And again, I know I'm putting you on the spot because we don't really know what those are, but do you have a hunch of what that would be?
Well, we don't have really a hunch, but I mean, well, I shouldn't say we don't have a hunch. We have a hunch, but you're right. We don't have anything concrete yet. But word is, there's probably a 20% reduction in affordability, regardless if you're buying or have your home. There could be a 10 to 20% drop in house prices. So if you take that, 21% in affordability and a 10 to 20% decline in home prices, that's essentially what you're looking at not having if you act later as opposed to earlier. That's my hunch.
Right. Like I almost think like there's like this triangle, if people can imagine like a triangle, and at the very top of the triangle of, people qualified to buy houses, there might be a couple people in Canada who can afford a 20, 50, $100 million house.
Mm-hmm.
And at the bottom part of the triangle, like the really wide part along the base, there might be millions of Canadians down there that can afford like a $100,000 house.
Right.
And I think what you're saying here is the net effect of this is when you basically drop 21%. So as you move up the triangle, now you get up to say the $700,000 price point, and there's X amount of people there. It's 700, and all of a sudden you now say no, you're only qualified for 560. Then all of a sudden that whole market basically disappears.
Disappears, exactly. Yeah, it just goes away. And this is, these changes are significant, and we're just trying to draw awareness as to what it means. Speaking to you today is definitely going to help. Some of that urgency around getting into that market today.
Yeah, and again, like honestly, for the people listening, like this is not dark clouds trying to scare people. It's just bringing awareness to it, and I think that's all we want to do. Like, just act now. Get your, home equity line of credit, or if you're a seller who is, I guess, concerned about or really requires all of the equity in the house for them to retire, probably not a bad idea to maybe go to market pretty soon. And I mean, again, we don't know if prices are really going to drop 20%, but I think there is some supply and demand forces in here. And if you drop the demand for houses at a certain price, then usually the market has to meet up. So if a bunch of people were qualified for $400,000 condos and now they're only qualified for 320, there's going to be a pause in the market until the sellers at 400 realize I don't have a market anymore, and the prices have got to come down slowly. And a lot of the buyers, I think, as they're watching this, will probably even sit there and go, maybe I'll just wait and see how this all works out.
Yeah, absolutely, and I agree with you. It's not, we're not trying to draw a message of doom and gloom, but more so, an opportunity in this window that we have to continue to keep on that plan that people had.
Right. So what impact will this have on people who are looking to refinance? Like, they're not going to take money out to buy a cottage or investment property. It's just, hey, we're coming up for a renewal, coming up to refinance. What do you see happening?
Yeah, that's a great question, and one that usually gets pushed aside is the refinance. But clients looking to refinance, they would be subject to the same guidelines. So if you're someone who's looking to buy an investment property, let's say with the equity that you've built up, now's the time to do so before these changes take place. Call your realtor and evaluate your buying options. Call Mortgage Savvy to help you utilize that equity to your benefit. This also goes for the homeowner who wants to use that said equity to renovate and help build even more equity that they have today. So, bring up that value of the home. pulling out this equity in a refinance for your home is the most inexpensive way to do so in both of those situations. And one thing that we've kind of seen over the last year since the original change came into effect is you'll see more of the bank of mom and dad come into play, where parents will help their kids get into homes by gifting them their down payments, and those parents, in some cases, will refinance their homes to do so.
Right. So what if, like, I always think, when I was selling, I would say to my clients, like, I helped you get into debt. Now my job is to help you get out of debt, and I would
Mm.
always sit with them a couple of years after closing or whatever and just kind of figure out, could we, is there a car loan? Is there a credit card debt? Is there some student loan debt? Is there some stuff that that's really high interest unsecured debt that we can roll onto their mortgage, so that their monthly cash flow is better, and at the same time we'd always like shorten their amortization down so more money was going to principal. I think this is the time now for more people to go, hey, if you have any outstanding debt and you want to roll that and refinance it on your home, that's probably going to be the easiest time now.
Yeah, debt consolidation is the most common reason for a refinance, and some of these changes are being led by the high household debt that people are carrying, and those high credit cards and those high line of credits, and if we can make that a little bit more affordable for you in a refinance and open up that monthly obligation for you, then there's more cash flow coming in, which essentially makes life a little bit easier.
Right. So what can we do just to better prepare ourselves right now? Or any words of wisdom to new home buyers? What would you say?
Yeah, for sure. I think the easiest way nowadays is the pre-approvals. It's important to understand that mortgage professionals like us can help you secure a rate under today's lending guidelines. So if you are someone who's still on the fence about buying, we can help you get that pre-approval, give you peace of mind if these changes do come into effect, because you will be under these current guidelines. And our pre-approvals are good for up to 120 days, and it'll help you make an informed buying decision without feeling that impact of the new lending criteria. Speak to your real estate professional now. The relationship that we at Mortgage Savvy have with our agents like yourself are not looked at as a referral source, but rather a partnership. And I believe you mentioned that partnership initially. And partnering together ensures that the buyer has one place for all of their needs, and we have their best interests at heart on both ends.
Yeah, and I have to tell you, you guys have been terrific as we've partnered with you. I know even in the spring when the market turned, and prices, went up 30%, and then they dropped back down, and a lot of people were caught in between. We were very proactive, I think, together, telling our agents, you've got to take the better covenant people on the offers. You got to try to get more down payment. You got to close a lot quicker because you just don't know how the market will change. And I know even dealing with you guys, I don't think, and I could be wrong here, but I'm not aware of any of the mortgages that you guys had pre-approved and that any of them did not close, which is a bit of a miracle because I know so many other people and, were really caught in the dust on that. And you guys, were just, your case was so solid, your underwriting was so good that, you kind of ducked the bullet. We all ducked that bullet.
Yeah, and it's being proactive really. And when we do our pre-approvals, we do it with so many things in mind. The future rate changes where we can avoid. Again, any type of changes from OFSI that are coming in. So it really is peace of mind. And when we do our pre-approvals, it's essentially an approval because we go through the whole process. You had asked me, some words of wisdom. What we do along with that pre-approval is we build a 5-year mortgage plan for you, and we say how you live your mortgage is really how you live your life. So typically, when you walk into a bank and get approved for a mortgage, they're very straightforward with each one that they do. Things like income, property taxes, the standards are considered, but that's where it ends. But instead, we go above and beyond by looking at your overall expenses, that life throws at you, like groceries, phone bills, vacation, social life. Taking all of this into consideration will help you understand what plan suits you best. And mortgages to us are not transactional at all, but rather a plan to a better living and lifestyle for both today and the future. So, it's very important to get that pre-approval and allow us to walk you through this process.
Yeah. I think the real theme here is, of this call is really, eh, it's your responsibility as a buyer or seller, as an agent, as a mortgage professional, to prepare yourself for the future. No one else's. That's better to be proactive on this instead of reactive. It's maybe better to be ahead of the curve right now. So I guess my advice for any of the buyers who are thinking about buying, or even for all of the agents who listen to this podcast, is now's the time to get proactive, and it's time to reconnect with your buyers, reconnect with your sellers, share some of the wisdom from this. When these podcasts get transcribed in a couple of weeks, we can always control the speed of that. But listen to this podcast. Talk to the people at Mortgage Savvy. Talk to your agent. Agents, talk to your brokers and managers, and let's get ahead of the curve on this. Like, this is a great opportunity. It's an opportunity for your buyers to get better terms, better qualification, get the house they want right now, or they can wait and then come into the market in January, February, March, where all of a sudden the market's just going to be in a bit of turmoil, I think, because all of a sudden they're not qualified for the house that they wanted to buy. And I think for sellers, there's a bit of a choice right now. Like, it's not fire, 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 sell your house, run away. It's just like, okay, there's an impact on this, and you have to be aware of it and just make your decision. I'm not selling my house. I'm planning on being my house for a long time, so I don't really think this will affect it. But if I was about to retire in a year or two and I needed every penny from this, and I was going to move down to a smaller house and take that extra money and go and invest it, then I think I'd probably get a little bit more proactive about it. And finally, is like, for the agents, is like, you have to know the base of this. You're not an expert in mortgages, but that's why you can talk to yourself, Rocco, or Rocky, and the people over Mortgage Savvy, and that's really why we have the partnership with them, because we know you need to know the working knowledge of this, but really for your professional expertise, you got to go right to the experts, and that's what I really like just working with you guys.
Awesome. And
Yeah.
likewise.
Okay. Just maybe last question or two before we wrap up. Where are you sitting right now? Would you, we've seen interest rates go up a little bit. So there's a bit of a split right now. Some people think they're going to go up higher. Some people say it's done. What would you tell people right now? Do they go variable, or do they lock into more of a fixed rate?
Yeah, it's the most common question we get, but every situation is definitely unique. Over the last few months, we've seen an increase to prime rates with an expected increase this year in this quarter, possibly in the next week on the next announcement. And word of two more coming into next year. So that'll be four increases in prime within a year span. Now, this has a domino effect on both the variable rate mortgages and the fixed terms, for that matter. So rising interest rates will definitely tighten housing activity, which could be further impacted if these new guidelines are implemented by OSFI. For us, we would always love to chat with those in this predicament and just to help them make an informed decision. The rate environment really has been dynamic, volatile, and can change quicker than what we live on a day-to-day basis. So understanding that fixed to variable choice can significantly help for a better future. I know that maybe didn't answer which way to go, but again, because we know that each situation is unique. For some, it could be in a variable rate mortgage. I can tell you that today, high ratio mortgages are being incented quite a bit because of that insurance that backs the lender. And there's still rates out there like prime minus 90, which may or may not suit that individual, but it is a conversation that we'd like to have and make sure that it's an informed decision in the end.
For sure. I guess really, as I'm listening to you, all I can think of is the answer is it depends.
Yeah.
It
Yeah.
really depends on what your criteria is. If what your equity, do you have a lot of equity in your home? Can you stomach a big, huge rate increase? Because we never know. And
Yeah.
I know when I started in this business, we were just coming off of really high rates in 1989, and most of our um, business we were writing at that time was at 15.9% was the mortgage
Yeah.
rate, and
Yeah.
almost every house that we sold had a condition where the seller would agree to pay $10,000 to the bank up front to buy the interest rate from 15.9 down to 9.9, so people could
Oh, wow.
qualify. So
Wow.
it's low rates don't last forever. But listen, Rocco, just wanted to say thank you so much. Really appreciate your time and your expertise. So thanks a million for joining me today.
It was an absolute pleasure. Thank you so much for having me.
All right, take care, Rocco.
Bye.